Market rally 6% in a week. Is it going to keep going? That's what we're going to talk about in today's 3 minutes on Markets and Money. Last week while we were on vacation, the market had a huge rally. Well, of course it did because we were on vacation and we weren't here to talk about it. But markets had a huge rally coming off support. This is one thing that we had talked about last week is markets were oversold. They were very negative in terms of sentiment. Positioning had gotten very negative, and that was really the kind of the prime setup. And we talked about this for a couple of weeks, that with markets trying to hold this support, that we were in a good position for a counter trend rally that should be used to reposition portfolios, rebalance risk, those type of things. Well, we got that last week, a very sharp reflexive rally here, back up into resistance here at the 50-200 day moving average crossover. Now, here's the important thing. Last week, we had a couple of pieces of news that gave some relief to a lot of the selling in the markets. On Wednesday, of course, the Federal Reserve hiked rates by 25 basis points, no surprises, and the markets had pretty much priced in what they expected the Fed to do. So without any surprises here, this gave a lift to asset prices. On Thursday and Friday, we had a very large quadruple witching, almost $3 trillion of options expiration, that caused a lot of short covering in the market as those options had to be rewritten. So that gave an additional lift. Now, that lift took the markets right into the 200-day moving average, which is where we're going to be challenging some resistance this morning. Doesn't mean that we can't get above that 200-day moving average and make an advance back up here towards around 4,600 on the S&P. Now, that rally, of course, would not really change anything. If the markets get to 4,600, that doesn't change the dynamics of this correction that we've been in really since October of last year. The markets have just been trading sideways within this very broad range. Markets, though, very overbought here on a short-term basis. The last time that we were this overbought was back here in early February, just before that second wave of the decline into the Russian invasion. So there is certainly some risk here in the short term. And again, why we talked about previously, use this rally to rebalance some risk. So if you've got positions in your portfolio that have not been performing well, if you've got positions that didn't perform well last week, think about reducing that exposure or eliminating it altogether. Honor your stop levels that you have on positions. Don't kind of hope that they are going to come back. Eliminate them from the portfolio, raise some cash, look for opportunities that have been performing well and that are moving back into a momentum basis and are on buy signals and appearing to have some relative strength here. Be careful of the commodity trade. A lot of those trades are very overbought right now, very extended. So again, risk there is that you're going to get some type of inflation reprieve. If you get good news coming out of Ukraine, Russia, we could see a very sharp reversion in commodity prices over the relief of that situation resolving itself. If the Federal Reserve starts to hike rates more aggressively, that's going to start to increase deflationary pressures as well later this year. Again, so be careful of the commodity trade. Doesn't mean it's over, but it is very extended here. A lot of people have already chased that trade. That's very overbought, very extended. So upside is probably somewhat limited here. Be looking for some opportunities and things that where we're going to be if we get back into a more deflationary, recessionary type trend in the economy. And those are companies and sectors that tend to have very stable earnings growth regardless of the economic environment. I'm your host, Lance Roberts, for 3 minutes on Markets and Money. Be back here tomorrow.